This week, we're going to talk about the development of a strategy that we originally created back in August of 2023. And it was because we had a low level of volatility. The VIX had dropped down, and as options traders, you know that when the VIX is low, opportunity for collecting premium is also low. That's because on that 0 DTE day, the premium decays much faster in low volatility. So most of the volatility that you would expect to see on that last day had already been decayed the day before or the day before that. And so there needs to be a kind of a remedy. Now, one of the things that you may have noticed over the past week or two is that a lot of the moves that were happening in the market were primarily happening overnight. And so if you look at the price chart, you would see a bunch of gaps. And then during the day, you would have tiny little moves, or what we call dojis. All right, friends, how you doing? This is Coach Ernie, and we're here with the 0 Days to Expiration podcast. And this week is going to be a series, like we do every week. We do a series from Monday, Tuesday, and Wednesday on a particular subject. This week's subject is going to be about invariance or edge case trades. Now, the edge case trade that I would like to address this week is the current condition that we have now, and that's this super low volatility. Now, in low volatility, you might think that, oh, that's great. I'm able to place my trades and feel comfortable and not worried about getting shaken out of my trade, but that's not really the case. As a options trader, low volatility is one of the worst places that you want to be because your options contracts are already drained of premium. And that's because when you have low volatility, the rate of decay increases dramatically. In other words, most of the premium that you would have expected to collect on the 0 DTE day has already decayed on 1 or 2 DTE out. And so that's a problem. Now, most traders have no idea that this is happening. They're just happy enough to put on their credit spreads and use their 15 or 20 delta and do some high win rate strategy and just go on, and they wonder why they have all this gamma that they have to deal with this time, and they have no clue, or why there's so much less profit available to them because they don't understand the concept of premium decay. This is what we deal with here as professional traders, that we are 100% in tune to the volatility regime and what that means for available premium to us and how we adjust our trade in those different types of conditions. And that's what this series right here for this week is all about. It's showing how we developed a strategy to handle that edge case. Now, what are some of the other edge cases? So you can think on the other extreme of things. You could have super high volatility. How do you trade that? Do you put on the same stupid 15 delta credit spread? No. First of all, I wouldn't ever use a credit spread or a debit spread. And that's another thing that will break their brains, break retailer trader brains. You say, hey, you know there's no difference between a credit spread and a debit spread, right? You know that. And that's a topic for another show. But in any event, retail traders will just put on the same damn trade no matter what the market conditions and then wonder why they get different results. Here, I'm going to show you how we developed a very specific type of trade to handle the specific conditions that come along with a low volatility regime. Now, this is going to be introducing a type of trade that normally we would put in very high volatility situations, but we're putting it on in low volatility for some specific reasons. And I have a presentation today, like every other day, and we're going to take a look at that. The trade that I'm talking about is the Batman, but this is a different variation of the Batman. Now, what is a Batman? A Batman is where we put a butterfly above the market, like a long call fly, and below the market, a long put fly. And when you put both of them on in your risk graph, they look like Batman's ears. That's why we call it the Batman. So we're going to talk about Batman trades on a 1 DTE strategy. Now, why would we want to do a 1 DTE when we're talking about 0 DTE? That is all because of the rate of premium decay in different volatility regimes. When volatility is very high, that has not the tendency, but it will delay the rate of decay of premium. Another way to say that is that premium becomes bloated in our current options contracts when volatility rises. When volatility drops, the premium is sucked out of those contracts, so there's less meat on the bone. Now, you may or may not have noticed this, but this is a fundamental thing that we do here as 0 DTE traders, is keep track of exactly how much premium is available and what is the rate of that decay, because that is everything in your ability in adjusting yourself to that condition so that you can collect the maximum amount of premium, because that's what we're after. You might think, what about intrinsic value? Yeah, you're after intrinsic value, but the reality is that intrinsic value is only available to you about 12 to 15% of the time. That's just the way it is. As an example, you've probably heard that long options only expire in the money about 12% of the time. Did you know that? When you start looking at your own strategy, you have the exact same case. So in other words, if you're looking at it from a 50-50 point of view, you're putting on a long call or a long put, there's only a 12% probability that it will land in that intrinsic value. Now, if you want to ensure that it gets inside that intrinsic value, you can do that by going way in the money and creating a trade that is extremely expensive, very expensive. So you'll be in the money, great. You won't have very much profit-making potential, and you'll have very little premium available to you as well. But the odds of you staying there and making a profit are relatively high. The problem with that is that you also incur a tremendous amount of risk. So if the trade goes against you, you fall down that gamma curve and you go right into the depths of hell, into the river Hades. And that's the problem with high win rate strategies. They are a canard. They are an illusion. They are a facade to something that seems intuitive, but it's going to kill you. The professional options trader is looking for that premium and understands that getting into intrinsic value or in the money is a low probability event. Now, that doesn't mean that you're not going after it and that you'll accept it. It just means that the realization is the vast majority of your profit-making opportunity isn't going to come from intrinsic value or getting in the money. It's going to come from your ability to grab the extrinsic value or that premium. And in order to do that, you have to understand the nature of premium and whether it is there or it isn't, and whether it's decaying or it's bloating. By knowing that, you can adjust your trade and adjust your disposition so that you can maximize the amount of premium that is available. That is what a true professional trader does. All the other guys that are out there talking about credit spreads and all this other crap don't know what the hell they're talking about. They say, oh yeah, the law of large numbers and high probability and pop and rock. And where has that gotten you? I'm asking, where has it gotten you? Put it in the comments. Tell me, where has the traditional way of trading gotten you other than small, tiny little profits and huge potential risk and you blowing up every once in a while? That's where it gets you. So what I'm going to show you is how you adjust to that condition. In this particular case, low volatility, and at some other time we'll talk about high volatility as well, and every other time in between we'll talk about the normalized volatility and how you adjust to that as well. The pro way of trading. You're here to understand how to be a proper 0 DTE or options trader. All right. Now, where did all this come from? Let's see, we'll do a little bit of a backstory here. But before we do, my goal is the mantra to help you become consistently profitable, make you an independent trader, and trade at a pro level. So everything that I am talking about today is geared towards those three goals, and those are the same three goals that I talk about incessantly every episode. Consistently profitable, independent, and trade at a pro level. Why would you want to do anything else? All right. Are you trading just 25% of the day? That is the fundamental problem when we start getting into low volatility or low volatility regimes. That, sure, we want to trade the 0 DTE opportunity, but the reality is that we only can do that on 0 DTE day between 9:30 and 4, which only comprises of about 25% of the day. When you get to low volatility, there's not as much premium available on that 0 DTE day. It has now been stolen from you, and it's been put onto the day before that. Yeah, I know all about the covered calls. They're wonderful until they aren't. And it's funny that the brokers will give you a lower level access to an account and let you trade covered calls because they say it's safe. That's because that it's being backed up by your stock. And all they care about is whether or not you're paying them commissions. So back to 25% of the trading day. When you have low volatility, a lot of that premium is not available on that 0 DTE day. It has already decayed on the 1 DTE or 2 DTE. And so what that's telling you is that, okay, there's a portion of that day that I'm missing out because the day really starts the night before. The entire trading session for SPX actually starts at 6 p.m. the day before, and it goes all the way until 4 or 5 p.m. of the current day. So if you have that whole 24-hour or 23-hour span and you're only trading 6 hours of it, you're only trading about 25% of the day, and you're missing out on the opportunity otherwise. The other thing with low volatility, you'll see that there are some periods where you get a lot of gaps. You see these gaps and then resulting dojis, gaps and dojis. That's what we're contending with. So most of the move is happening overnight. And then the day when you want to trade, there's not much movement because you're resulting in a doji. And I'm not saying that there's less than 25% premium. I'm saying that you're only trading 25% of the day. You're missing out on what's happening overnight, and that's where all the premium decay is happening and the movement in the price. That's the point. Okay? So in order to recapture that movement and that premium decay, instead of concentrating on 0 DTE where you've lost out on it already, and this is a particular case when there's low volatility. I want to make that clear. This isn't all the time. So you might wonder, well, why don't I do this all the time? No, we're only doing this in low volatility situations where those gaps and the decayed premium have already occurred, and we want to recapture it. So when you get into low volatility, you change your orientation. You say, all right, 0 DTE is not working out. I need to go to 1 DTE so I can recapture those gaps, those moves that happen overnight, and all the premium that has already decayed. That's the setup. And so we started to create or experiment with a new strategy that is exactly what I'm talking about today. And that is doing a 1 DTE instead of a 0 DTE, and try to recapture that gap move or whatever. Now, we don't know if it's going to go up or down because, as you may have ascertained from previous shows that I've done, you don't know on any given day, even in a move up, whether that day is going to be end up or end down. It's still a 50-50 shot, no matter when you're talking about. So you look at this trend up here, and if you were to count all the up days and down days, you would find that they are about equal, even though the market's going up. So we don't know. We don't know whether it's going to gap up or gap down, but we know that the volatility is still low, and we're probably going to have a doji day, and we're going to have a big gap. So what we do is we put on a Batman the day before. And we typically will put it on at the end of the day so that we can capture everything that I said that we're missing out on. And so this show is all about that setup. That's what I want to go through. And then the next shows we'll talk about the trade itself. And then on Wednesday, we'll talk about results and what we have seen and how that has manifested into a new strategy in our VIX playbook. You all have the setup, right? Low volatility regime and overnight gaps. Low volatility regime meaning that premium has been sucked out of our options and making the 0 DTE trade very difficult because there's less meat on the bone. And on top of that, we don't get these big moves in those low volatility regimes. We get a lot of doji days. I'm not saying all of them are, but a lot of doji days. So what we're trying to do is combat both of those situations by putting on a trade that's on both sides of the market. We don't know if it's going to go up or down, and to capture that premium decay. Now, by doing it later in the day, we can get a fairly good price on our trades. And I'll talk all about the setup and how big you make those flies and how far out you push them. All of that is going to surprise you because almost everything that I do surprises you because it's nothing like what you've ever done before unless you've been in our service, which is Fly on the Wall, or our 0 DTE trading service, where we have hundreds of traders that are trading this way and they're realizing profit because they take the proper orientation to volatility regimes in the market condition. That's what you're learning here. All right. So let's go back to the presentation. So here's the setup. All-time highs, VIX is in zombie land or near it. This morning it's just slightly above it, but we're going to get down there for sure if we remain up here, and if the war ends, everything's going to point to that. And we're looking at a 24-hour macro tape. In other words, we're expanding our horizons from 6.5 hours during market time to a full day. So what that means is that we're actually entering the trade the night before the market closes. Or if you have futures, you can enter it after the market closes, or if you have a broker that allows you to do extended trading with the SPX, you can do it right after the market closes. In any event, we're putting on a Batman, and that is a long call fly and a long put fly above and below the market, respectively, to handle exactly this situation. And that situation, where is your strategy actually exposed? See, this is where you're trading normally in the yellow, but this is where in the gray area is where most of the move is happening during these periods. Just think about that. You're missing out on all that movement. By setting your trade the night before, when you end up into that tradable area, that tradable hour, presumably the market has already then moved into or near your strategy, and so then you can profit. And you're also able to take advantage of that premium decay. A doji is a candlestick where the open and close are very compressed, and you might have tiny little tails above and below, but there's relatively little movement in that day. Now, there's enough movement on those tails that will pay on your Batman, or on a very lucky day, you'll actually end up right near or inside of the profit tent of one of those Batman trades. All right. And then the gaps are the difference between the previous close. In the case of a green day, that's the top of the candle. On a red day, that's the bottom of the candle. All right. So here we closed and here we opened. See, there's the gap right there. And here's another gap where we let's see, where we closed. It's actually like that. And then where we opened. There. That is, so there's no real gap on this day. This is what it should look like. So we see where the opportunities are. here, and here. That's not going to happen every day. Yeah, it's just, this might be a little bit of a gap. That often happens as well. So this is what I'm trying to illustrate. So we have a big gap here and a big gap here, maybe small gaps here and here. And you saw it when I showed you the TradingView chart, that as we're moving up into all-time highs, you start seeing a lot of these gaps and tiny little doji days. So here's the big thing, and the difference between the way most retail traders trade and the way we trade. We're not guessing at our trade. We're not just haphazardly putting on the same 15 or 20 delta credit spread trying to capture something. That's insane. Instead, what we're doing is we're creating very specific trades. They're all basically the same kind of trade, out of the money butterflies, right? With the same kind of risk to reward. It's just that how we size them and when we place them and how we orientate them, that is specific to the current market regime and the situation. All right, so we have some other questions here. So when the market gap's up or down, is that due to market buying more, selling more, due to, I don't care. I really don't care. I wonder why I kept missing the move. So Stephen, the only thing is that it happens, right? So now you have to figure out a strategy that will capture that. I am not saying that you're going to tell whether the market's going to move up or down. I have no friggin' idea. Period. End of story. I don't know. Do I use a certain delta? Never. Using delta is the pussy way of trading. This is a trader show, so I can use language like that. But it is. It is showing a lack of understanding of what delta actually is. People use delta to try to get a high probability trade. And I'm telling you, that is exactly the wrong thing that you want to do. What you should be focused on is the amount of premium, where the VIX is, and the gamma. Delta will take care of itself. We can't see, the reason why they go for these low deltas is because they're trying to put themselves into a high probability situation. But at the same time, they're putting themselves into a huge risk situation. And that's the killer. So move away from these low delta trades because they are dangerous. All right, you guys are saying worldwide trading, Stephen, gaps occurring in other markets, if I understand it correctly. It doesn't matter. The markets go 24 hours a day. And yes, you're right that the trading goes on 24 hours a day. We just have a window of opportunity during U.S. market hours. And so that's what we're looking for. But in order to trade these correctly, you need to set up a trade that is coincident with the way the market's acting. If it's low volatility, then you have to take that into consideration. Accelerated premium decay, greater gamma, less meat on the bone. If it's high volatility, then we know that it is delayed premium collection, that there is more meat on the bone, and we're going to have wider disposition or wider trades because we can afford to, because we can get into them cheaper. There's lower gamma. If you don't play what the situation is, you're never going to be able to affect a consistent return. All right, let's go on to the next slide. So as I was explaining earlier, this started as an experiment in late 2023. We noticed this situation, and so we decided to put on a trade that we would collect about 6 months of data. And we had one particular member of our group that decided that they were going to do the tracking for it for everybody else, and everybody would practice that trade. And as we did this over and over, so here's the Discord, and the trader is Logger. Here is an accounting of a typical week that we were doing this trade. There are winning and losing days, but overall this week, from Monday through Friday, was a winner of $1,526, putting on small trades each day. The previous week only made $243, but overall, this trade made quite a bit, actually. It was, with a relatively small account, you would have made somewhere between 40 and 60% over the course of a year in an annual basis. And that's pretty darn good. With essentially a very mechanical way of trading. The only thing that you're really focused on is the exit criteria. And the exit criteria is very simple. But by putting these trades on prior to this, we didn't know whether it's going to end up in or near our trades. Each one of these green and red rectangles represents a butterfly and where they would place relative to the price. And so we put these on the night before. Here's an example day where it was a near pin trade where you get huge returns. And other days, and like here, it was another pin trade, but in this case, got out of it early because of our profit management. You can see where the exit happened with the little yellow arrow. So if we were to go on and on through Logger's account, you would see he placed these every week. So here's another week where you had 3 bad days or days where things just didn't pan out, followed by a huge day. So still, one winning day can make a positive week. So anyways, we went through this over and over every week. And as you can see, placing these trades, et cetera, et cetera. So this week here, this day, $1,800 return, followed by a few smaller wins, 260, 265, 285. That's probably more than I would have traded. I probably would have traded closer to 200. That was this trader's instructions, was to trade smaller, but I guess put on the trades that he thought that he could get. That's the experiment that happened during that period of time. Here, let me change the, go back to the big head and get back to the presentation. All right. That was the setup for the trade, low volatility, overnight gaps. We decided to create an experiment, 6 months worth of data. That all resulted in us affirming our hypothesis that it worked fantastically. And now it is a regular part of our trading regiment. Now, but it's a edge case trade, and that edge case, the reason why I'm talking about it is because we are entering into that edge case, and I expect to see that condition perhaps last for the next several months. We'll see. We don't know for sure, but we know that when we're in that kind of situation, this is a very effective strategy. And can we recapture it? Absolutely. Let's see here. Let's go to the next slide. So you might think that a low VIX equals a quiet market. And yeah, conventional wisdom would say so. But the reality is, in a low VIX market, because we have that accelerated premium decay, we also have higher gamma. When you have higher gamma, that means greater sensitivity to price. Greater sensitivity to price means that you're going to get shaken out of your trades. And a lot of people don't realize that. When you're trading options, your options will have steeper gamma and less profit potential. So you have more risk, less profit potential. When you have higher volatility, you have lower gamma or less risk, less price sensitivity, and higher profit potential. That sounds a lot better. Now, most retail traders don't understand that dichotomy. They think that high volatility is worse and low volatility is better, when it's the exact opposite, because they don't understand. All right. So let's go to the VIX playbook so that you can see that. And I've shown this many other times, but I have it on my trading view chart. And that is trading view, but now I need to go to the VIX tab. And this is our playbook. We look at this every day. All of our traders, we consult this and see where volatility is, and then determine what type of trade, whether it's going to be an edge case or the standard trade or another edge case or whatever, and then how we're going to orientate our trades, how we're going to size them. And you'll see that we have this one trade that we call time warp, and this is the trade that I'm talking about. It's actually a cross between the Batman, which you see right here, which is normally a high volatility trade, married to a low volatility trade. And that's when we get into these extremes. Now, by the way, you don't have to do a Batman on time warp. You can still do the standard follow the trend type of deal, and that will work just as well. But the Batman is an easy trade for you guys to put on. And while it makes a little bit less than just putting on a single trade and following the trend, It is super easy to implement, and this is why I'm showing it to you. It's a mechanical trade. You put it on every night. You don't have to really think about your entry. You just place the trade, and then the next day you wait for it to pull in. It's either going to pull in close to your profit tent or it's not. If it doesn't, you've taken a defined risk. And we'll talk about exactly what that risk is tomorrow. But our playbook is showing us, hey, when we get into lower volatility situations, we start looking at greater DTE. So normally we're looking at 0 DTE through most of volatility regimes, all the way through Goldilocks and into chaos. Then we get into zombie land. See, zombie land's right here, down below 17. We start looking at longer DTE. And the further down we get, if we get all the way down to 10 on the VIX, then we start looking at even longer. That's because the premium rate of decay has increased dramatically, leaving very little meat on the bone for our 0 DTE or even our 1 DTE days. So that's why we go further out in much, much lower volatility. All right, so that was the result of the experiment that we did over the course of, what was it, about 6 months. And all of our strategies are that way, except for the primary strategy, which has been refined over the past 7 or 8 years, over thousands and thousands of trades. So all these strategies are developed based on market conditions, empirical evidence, and results. And that's what we offer. If you want to trade this way, go down below, click on flyinthewall.ai/try, join as an observer. You'll become a full-fledged member for 4 weeks, and you'll get to see how we actually do things and see how other traders are becoming professionals or trading as a professional, and how we adjust ourselves according to market conditions and give ourselves a proper risk-adjusted return. And don't go after high win rate, which is a canard. It's going to kill you. All right. That's about all I have to say. Tomorrow we're going to continue this conversation. We'll start getting into the details of the trade, how we place it, how we execute it, how we manage profit, etc. All right. Here's a question. Can you do this in the ES futures options for smaller accounts, not to worry about the PDT rule? I think the PDT rule is now starting to go away. But the answer is yes, you can absolutely do it with the E-mini S&P futures. The only thing with the futures is that an equivalent butterfly on the ES costs about a $21 round trip. So if you're doing 2 of them, that's $42. So you have to overcome the hump of $42, where a butterfly round trip on the SPX is about $9.60 or so. So that would be about $18. So $18 versus $42. You might get a slightly better return. Plus, for that $18, you're trading a much, much larger trade because the ES is about half the size of the SPX. So not only does it cost about twice as much, but it's also half the size. So it's about 4 times more expensive than the SPX. So that's the only thing that you have to worry about. The advantage of trading the E-mini futures is that you can put them on and take them off overnight or early in the morning before the market opens. So if you find yourself in a profitable situation at 7 o'clock in the morning, you can take the trade off, which you really can't do with the SPX unless you're trading with one of the brokers that allows you to trade outside of market hours, like Fidelity or IBKR, Interactive Broker. So that's the deal there. All right. All right, there is another question. Can you at some time discuss capital allocation for various size accounts? What is allocation for a Batman trade, for example? Each trade, if it's an SPX and they're 20 wide and we're trading them at 5% of the width, that's $100 per trade or $200 for a Batman for each day, approximately. All right. I will go over in detail what size of accounts and how big your position should be. Should you be putting on just a single put and a call, or should you put on 2 or more? And I'll talk about position size as well. But if you want to know more about position size, go to some of my previous shows where I've talked about position size in great detail for the entire show. All right, and then that will explain how you determine your position size to regulate and determine your drawdown. All right, again, if you are interested in this style of trading, which is a professional way, then go down below and try us out. Go to flyonthewall.ai/try. There you go. We'll see you tomorrow, and we're going to continue this conversation and talking in more depth about the particulars of getting in and managing this trade and taking profits. And then on Wednesday, we'll talk about what are the results. All right? Give this video a thumbs up. Subscribe if you're not already subscribed. And we'll see you tomorrow. Peace.